Hey everyone, and welcome back. Happy Friday. So a friend of mine from middle school and high school actually saw my videos and sent me their portfolio, which I really appreciate. Thank you so much for reaching out to me and sending me your portfolio. This is all anonymous, so if you want to share yours, please do. Now this person has a ton of stocks and they're aware of that. I want to go through it. I know that I'm not going to go through all of them. I'm going to go through the ones that are in bold mostly. And just to begin, a lot of these are individual stocks, which are also made up of some of the ETFs that this person's in. So there is going to be heavy overlap with that, and they're also in multiple total stock indexes, so that could also be overlap. So I'm going to go through everything. I'm going to do a very short ETF overlap at the end, just on those like 3 or 4 that are overlapping, and then I'll do a pros and cons of the fund and what my thoughts are. But obviously, I'm not a financial advisor, so just do your own research. This is just for educational purposes, for fun, and we're going to go through it now. So we see here that they're in ASML. I'm not sure when they got into this, if they were aware that the market was going to do really well with semiconductors, but this is a semiconductor stock individual. And we see that the 1 year is 86%. So amazing gains on the 1 year for the semiconductors. We know that semiconductors are going to do well this year, hopefully, if all goes well. Elon Musk and other people who are in the industry projecting that there's going to be billions of robots. And that doesn't mean beep boop beep Android robots. That means like robots that help deliver packages, robots that help drive cars, robots that help with manufacturing, and the manufacturing robots, cranes, all of that stuff. And they need semiconductors to be able to build those robots. So we're going to expect another good year for semiconductors. Next, we see the iShares Latin. So they're going to be in a fund that invests in these Latin companies. And I bet you this did really well in the year. We see 47%, so good job having this. This is an ETF, so it's diversified in the Latin market. And we know that emerging markets and the international markets are going to do really well probably in the next couple of years. These outperform the S&P by more than double, a lot of them, you'll see. And so next, we see that they were in a China fund. Look at the 1 year on China, 38%. They're in Chinese companies, so again, you're diversified across each country. And these, so far, that's 2 separate countries. Now let's get rid of these so we don't get any delay. Now we see that they're in Toronto, and so this is a Toronto index, so they're in every single stock that could possibly probably be in on Toronto. And we see the 1 year, we see 33%. So again, really good gains. That's 3 separate countries they're in so far. Now we're in a Vanguard S&P. We see here that they're going to invest primarily in the markets that are in pretty much all in the US, and we see it's made up of all the same companies that these typical total stock have. We've seen NVIDIA, Apple, Microsoft, and we did see from the beginning, which we'll go back to again, that they're in a lot of these individually as well. So if you wanted to take a more global risk, then you want more holdings in NVIDIA, certainly go ahead. But if you're not meaning to do that and you're meaning to be diversified, then it's better just to have, in my opinion, and you want to be invested fully, then you would do ETFs, which already make up some of the holdings that you have. And we see the 1 year was 16%. If you saw, this is less than half of all 3 of the funds we looked at from Latin America, from Toronto, from China. Next, we see the iShares dividend. So this is going to be dividend fund. You see here that these are very good companies. They pay dividends on a monthly, quarterly basis. So if you want to make income, then this is for you. You see it has less percent gains, but you get the dividends. And we see here that it's a nice trajectory up, so you're not getting NAV erosion, which is when your box of toys gets less and less, but you don't replenish it. Here it's getting replenished and it's gaining gains as well, rather than just dividends. And be careful, because if you're not claiming these if you're claiming these as income, you're going to be in a more income bracket. So make sure this is in an IRA where you can't touch, and the funds are automatically reinvested. Next, we see emerging markets. So because you're in emerging markets and you're also in the individual ETFs for each country, that's not really diversified, because you're already investing in the individual companies. And the emerging markets, if you want to be in individual countries, this is a good play. But having all countries and this, you're not really diversifying, and you're not really getting the gains that you think you're getting. Because if you just had all that in this, you'd be getting the same gains. We see the 1 year is 15% on this one, and we see that they're investing in Brazil, we can go right off the bat. I'm not sure where these other companies are from, but we'll see that they're in other emerging market ETFs as well. We see that they're in also Mexico. Mexico 1 year is 54%, so amazing gains. I'm not sure if you were aware of the emerging markets and if you have the knowledge about them, but good job for being in all these countries because you made some decent profits. And we see here it invests in Mexican companies. Next, we see that they're in a total stock market index, which we already saw. I believe that they were already in one. So this is the second one. We see here again the same companies: NVIDIA, Apple, Microsoft, Amazon, Broadcom. Primarily going to be 80 to 100% overlap with the one that you're already in. Next, we see another one, a large cap growth, which is good. So this is going to be like a QQQ. So it's going to have mostly technology, and it's going to have a few others as well. And we see here, look, mostly technology, and then it's in the same companies though. NVIDIA, Apple, Microsoft. So this is going to have pretty significant overlap, about probably 50-60% overlap, maybe more, with the one we just looked at. Next, we see another Vanguard Total Stock Market Index, VTI. Watch, it's going to be the same companies. NVIDIA, Apple, Microsoft, Amazon, Alphabet, C Technology, and you're also in these individually. So personally, I would combine these into just one of them. Look at how they perform overall. Look at which one does best over the years. They're going to be about the same. But I would just pick one unless you're in those as the other ones as index funds for a 401k. You can't get out of it. That's obviously fine. But if they're all in the same fund pool, maybe think about consolidating because you're not spreading your risk. Next, we see look, another total stock index, and we see here that it's the same funds. And lastly, well, there's two more. You're in a Spider S&P fund 500, and look, the same companies. So the VTI, the VOO, the VT, and the those other indexes that were 4 or 5 digits, they're all almost 100% overlap. And next we see Vietnam. Vietnam had a really good year as well. Look, 74%. So really good job being in Vietnam. You had some good research if you just got in these last year. So we see here the Vietnamese companies. Next, we see emerging markets. So let's see the 1 year on that, 28%. So some of the individual companies beat these. So good job being in those. If you're not intending to be in all the individual companies, if you're not intending to be in the individual countries, then put more into the emerging markets ETF as opposed to each individual country. Because depending on how many you get of each, you may make more gains if you put more money into the ETF rather than spreading them out through all of the different countries. And we see here, I'm not sure where all these are from, but we see China, we see Taiwan, at least on these two. So now I do want to show you your overlap between, let's just do SPY and VOO. We see 100% overlap, basically. Now if we do VTI, you see 88% overlap. Now if we do VT, we see 55% overlap. So if you wanted to get out of VTI and get out of VOO, because we just saw that there's 100% overlap, maybe do SPY and VT because there's 50% overlap. I won't be able to show you those other indexes that we looked at because they're not an ETF, but we saw that they're made up of the same exact companies. So that's this video. Let me go back real quick to the live scene of all of the different funds they're in. We see that they were in Apple and we're in Google, we're in Netflix, I believe they're in NVIDIA, and they're in CVS and Walmart. A lot of these are going to be already in the ETFs you're in, so there's not overlap. So depending on what your goal is, you may want to try to consolidate. And here's a main reason. A main reason in consolidating is that unless you have a lot of free time and you're looking and tracking all of these to see what's happening, it's overwhelming. There's just not enough time management to go through all these personally. Like I believe there's Netflix here. If you know that Netflix has actually been tremendously down. So unless you bought these at a low rate and you think that Netflix is going to have a good year, you've lost money on that when you could have diversified it and put it into an emerging market and made tremendous gains. So that's the only problem with being in so many things. Personally, I'm only in 5 different ETFs and I'm in 2 different mutual funds for my 401k, and much easier to manage. But a pro is that you're diversified in the sense of if one stock goes down, you have a lot of others for support. If one country does well and other countries don't do well, it mitigates your risk. So that's definitely a good position in the sense of reduced risk. But again, there's a lot of ETF overlap with some of the stuff you're in, so that's not a good diversification risk. So depending on the weight of all of your ETFs and stocks, you may not be as diversified and risk adverse as you think. For example, VOO, VTI, SPY, FXKAX, and FSPXGX are all literally virtually the same. So when those go down, they're all going to go down. If you're heavy weighted in those, you're going to lose a lot of money in your portfolio during that time. But of course, if you're going to be in for years, that's fine. But try to consolidate all the ones that are overlapping more than 80%, because it's silly to have each individual one, because it's ease of mind by just having one if they're going to be 88% overlap, because then you don't have to look at all of them and see how they're all doing, and then you're not really even diversified. Really good job with the ETFs in the emerging markets. Those are going to do really well over the years. Keep a lookout in a few years. I would just do some research on where you think they're going to go. Maybe try to merge those into it and look for the best growing ETF for emerging markets, international. Maybe keep some countries, but try to diversify in the sense of the countries and what they're investing in. And if they're overlapping technology funds like Taiwan, we see a lot of countries invest in that. Just be aware of that. Overall, just because you're in so many, I want to give it like a B minus, but it's really good in the sense of how many gains you saw. So good job with that. If you want to send me your portfolio, please do so. That'd be great, and I really appreciate you sending me this one. Again, it's all anonymous. Have a great day, everyone.